And hello, everyone. Welcome to Rule Classroom at ruleclassroom.com. I'm Albert Liu, joined as always by Rick Rule and our fabulous Rule Classroom community. Rick, good to see you. How are you?
Pleasure to be back, Albert. We had a good reason to be back, of course, with the conference, but it's delightful to be back in this format. Thank you, as always, for causing it to occur.
Thank you, Rick. Let's get right to it. We like to start here with some opening remarks from you based on what you're seeing in the market, what's going on, what's of general interest or specific interest to you. So why don't we start with that before we turn it over and get some questions answered?
Well, in a general sense, I think it's interesting to see the market's reaction to choppiness. It seems like people are silver bugs when silver just goes up. They're uranium bugs when uranium just goes up. They're gold bugs when gold just goes up, and copper bugs when copper bugs just go up. I think a mark for your affection around a narrative is your enthusiasm when it goes down, so you can buy more cheaply. It's very odd to me that people's attraction to a narrative can't stand a 5% price decline. I guess I got over that in my 20s. Granted, I experienced much more than a 5% price decline at the end of my 20s. But from my own perspective, if you develop a fondness for a narrative, as an example, my fondness with the uranium narrative, and you see the stock sell off, that's probably a time to buy. If you have developed a fondness for the narrative and you see the stocks explode upwards, that's probably a time to do some selling. I'm struck reading comments in social media, particularly around X, which is the biggest social media community that I inhabit, the fickleness of the speculators in the place. It seems that a move in the uranium price from $86 to $82 has that community unnerved, which really amuses me. There are some real reasons why some of the faithful have been tested, in the sense that those people who were holders of uranium assets in Niger were faced with the reality of political risk. In the case of Global Atomic, they were asked to begin construction, and the bank refused for a little while to extend the construction loan. So Global Atomic has been forced to go to the market. In the case of GoVX, of course, they have been at least temporarily stripped of their mineral rights or their rights to mine. So for that part of the junior uranium space, the precipitous price declines that you saw in both equities are real. But it's interesting the negative furor engendered, both by the very small retractions in gains experienced in the community, and then the realization that political risks exist, and trying to extend concern about political risks in places like Niger to places like Kenya and Tanzania and Namibia and Botswana, assuming incorrectly that all of Africa is the same. That's certainly something that has amused me in the last couple of weeks, Albert. Two, the darling, I think, at the conference was copper. The very recent weakness in the soft copper price should have made people who were attracted to the copper narrative more ambitious on the buy side. But in fact, the fact that the chart doesn't show stairways to heaven seems to have obviated in 2 or 3 weeks all of the enthusiasm built up in the market in the last 6 months. I'm not lamenting this personally. I'm hoping to use this as instructional material for those people who are paying attention here in the Rule Classroom. Remember, as we've said before, the cure for high prices in the near and the long term is always high prices, and the cure for low prices is low prices. If you're attracted to a theme, and you're attracted to a theme in the 5-year time frame, don't try to employ short-term tactics around long-term strategies. In fact, use this price volatility to your advantage. If you don't know enough about a sector that you can't stand the volatility, leave the sector. Go do something else sensible with your money. I would say that's my general comment. My specific comment is something I've talked a lot about on social media, and I've talked about it here too at Rural Classroom. But I think it's a very important investing theme, particularly as the uranium equities are experiencing a broad sell-off. And that is this: the structure of the uranium market is really changing, and really changing to the benefit of the uranium developers. When I say changing, the driving price mechanism in the physical uranium market has been the spot market. But spot market volumes have really dried up, both on the buy side and on the sell side. They are adequately supplied, but the truth is, on a daily basis, the Sprott Physical Uranium Trust generally has more dollar volume than the spot uranium market, which is one way of saying that the Sprott market has become the spot market. Very recently, people are concerned about lack of momentum in the uranium market, so the Sprott Physical Uranium Trust is selling at a rather substantial discount to its net asset value. That discount or premium is usually a pretty good indicator of short-term sentiment around uranium. Short-term sentiment around uranium looks weak, which means I think I'm getting ready to be a uranium stock buyer. And here's why. As the market mechanism goes from a spot market to a term market, in uranium, unlike any other commodity I know, sellers, uranium producers, can enter into contracts with buyers, preferably investment grade buyers, to buy specific quantities of uranium at or above a reference price over a specific period of time. This ability to lock in price certainty for 5 years or 10 years or 15 years or 20 years, certainty with regards to price, gives everybody, the lenders, the investors, the analysts, a better sense of what both revenues or volumes are going to be. And it gives them a better sense in uranium than exists in any other commodity that I know of. The importance of this trend for the smaller uranium companies is that those uranium companies who have bankable feasibility stage projects can enter into supply agreements with investment quality takers and can use those purchase contracts as security for construction loans to build uranium projects. You can't do this in the gold business. You can't do this in the silver business. You can't do it in the oil and gas business. You can't do it in any other natural resource business I know. This new financing mechanism hasn't taken hold yet. And it hasn't been expressed in the market yet because companies are not forced currently to disclose their contracts. But believe me, lenders like myself are going to force them to disclose the contracts if they want concessional terms on loans. In a capital-intensive business, the cost of capital is a durable competitive advantage. And my suspicion is over the next 5 years, that disclosure around contract terms is going to become the norm, not the exception. And what this means is that companies that hitherto didn't have a prayer of putting their projects into production because they couldn't raise the capital, companies that would have been forced to sell themselves to larger mining companies to get their mines built, will now be able to at least threaten, to obtain the financing and put the projects into production themselves. I think that this will lead to, over the next 5 years, a much more vibrant market for development stage uranium companies. And I think it'll actually enhance merger and acquisition activities, as the major mining companies know that they can't wait out the juniors. They can't starve them out looking for production finance, because the juniors will be able to obtain construction finance. A very, very interesting circumstance, and one that I'd like to see the participants in the Rural Classroom, at least those participants who are interested in uranium, discuss more about and learn more about. And Albert, this may be something where we want to bring Scott Melby or some of our other uranium market participants into the classroom to discuss in some more detail, if the community tells us in the comment section that they're interested in that discussion. I think they should be. I think it'd be a fascinating discussion.
Rick, we've been talking about uranium for a long time, and I'm fascinated about how this keeps evolving. The story keeps evolving, and there's new catalysts for opportunity. And so, what you're describing is, if I understand it correctly, is an opportunity for smaller firms to leverage the balance sheets of larger firms through contracts to get favorable terms on financing that they wouldn't have been able to get before.
Maybe a little deeper then. Most of these companies wouldn't be able to get financing at all.
That's better
Now,
terms. Yeah.
yeah, now, a company with a sort of a mid-sized project, a $250 or $300 million project, can sell enough production on term, provided that they don't sell it to a trader, provided that they sell it to a credit grade counterparty, a Tokyo Power, a China General Nuclear, a Duke Power, a Southern Company. And they can take those purchase agreements literally to the bank or to me or Sprott and obtain construction financing where that otherwise would not have been available to them. This is a real game changer, and it's a real game changer that isn't present in any commodity that I know. I have a sneaking suspicion that if we begin to see transactions like this that benefit both the supplier and the buyer over time and aid the industry in obtaining construction finance, I suspect that the second commodity group that you're going to see adopt this pricing mechanism will be the lithium companies in, say, 2 years or 2.5 years. But it's going to have to develop in uranium first.
And there's enough of those very high credit worthy purchasers for this to be to affect the industry in a meaningful way.
I guess you need to decide whether Tesla is a credit worthy counterparty, but the market seems to think it is.
Shareholders are getting restless.
I have trouble both with the balance sheet and the income statement, but both of them are big.
Yeah.
If nothing else.
Yeah. Okay, so let's get to this international audience we have. Special hello to Dean Trejo, who's joining us for the first time. And also hello, Mark from Sweden, Felix from Germany. Let's see, Boniface from London. Lots of people. Okay, so let's get to the first question from David. Rick wants to know about your thoughts and ranks on Vizsla and Hercules Silver. So I assume it's Vizsla Silver and Hercules Silver.
Yeah.
And are you still concerned about Mexico?
I am still concerned about Mexico. The woman who has ascended to power in Mexico is, I think it's fair to say, anti-mining, particularly anti-open pit mining. She's a successor to López Obrador, AMLO, who was no friend of mining himself. But it would seem that the hostility to mining is going deeper. In addition, she is reported to be hostile to the old capitalist caciques in Mexico, the people who run such companies as Peñoles, the biggest mining company in Mexico. So I am concerned. I'm particularly concerned around companies that propose to do open pit mining. I'm less concerned probably around Vizsla because I think that's going to be a high-grade underground deposit. I was attracted to the headline numbers in their preliminary economic assessment, understanding that it is preliminary. If I had criticisms, going over that thing, it had a very, very high net present value, over $1 billion, for a $250, $260 million upfront capital expense, a wonderful relationship between capital intensity and net present value. It's worthy to note, though, that the net present value was done at a fairly high silver price, $26.50, and was done at a 5% discount, which is too low. Given that the investment banking standard for discount rates is 5%, you have to run a 5% case on all models because you have to do an apples to apples transaction. But in your own mind, if you're trying to do a net present value that works for you, you are much better off running a 10% discount case. And then you are much better than that running a conservative case. A conservative case uses as a discount rate the issuer's cost of debt capital. It's very likely that when Wisla goes to obtain project financing to put this project into production, that they're going to be paying total costs of around 15%. So if you run a 15% discounted net present value relative to a 5% discounted net present value, you're going to get a truly ugly number. Would-be analysts, amateur analysts that are watching us today, Albert, need to be cautioned not to use a 15% discount for one company and compare that to a 5% discount for another company. It's important that you do apples-to-apples stratagems. But I think in terms of valuation, that Wisla points out the fact that in everybody's valuation case, you have to have one conservative case. A conservative case would be a cost of capital discount, often 15%. It would always, in every case, be after tax, not pre-tax. And it would stress test the commodity price, which is to say a commodity price 20 or 25% below current prices or below the forward strip. This isn't the expected outcome, but it's important that speculators have in their mind an optimistic case, a base case, and a cautious case, which will allow the investor to better deal with things like volatility in the market. I know the question wasn't about discount rates, it was about Wisla, and I'm very, very attracted to what Wisla did. I just want to point out that the headline number on that preliminary economic assessment, the 80% IRR, relied on aggressive commodity price assumptions and a very aggressive discount rate assumption. I sort of ran a back of the envelope, very, 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 very rudimentary adjusted case, and I came up with much closer to a 30% IRR as opposed to a 70% IRR.
David, great question. It's the additional insights that we're here for, Rick. So thank you for that. Guillaume says hello from Singapore, very early in the morning. And Jake has a question. Would love to hear Rick's opinion on Newmont's Q2 earnings.
Disappointing. Newmont misses and misses and misses on costs. I don't know if they're trying to be too aggressive in their guidance, or I don't know if they're having operating problems. What I do know is if they follow through on their announced strategy, which is to sell their Tier 2 mines, use the proceeds to pay down debt, and focus all of their love, care, and attention on their larger, low-cost mines, that most of the problem with regards to cost variance probably goes away. But I have to say it was a disappointing number. The way they defined free cash too, which is to say free cash at the operating level, but not free cash at the enterprise level, was disappointing. I had hoped at this gold price, given 3 quarters to constrain operating costs at the mine level, that they would be free cash positive at the enterprise level, which they aren't. They are certainly free cash positive at the operational level, but they have capital expenditures, they have general administrative expense, they have interest expense. They aren't free cash positive at the enterprise level, which is disappointing.
Okay, from David, do you think Global Atomic is a buy here? The recent raise was oversubscribed.
I don't have the courage to buy it here. To put the question in context, Global Atomic would appear to have conditional approval from the government of Niger to go ahead, with the implicit assumption that if they don't go ahead, they're going to be stripped of the mineral rights. The bank had said that there's going to be a 1-month delay in the advancement of funds. And what Global Atomic has had to do is to go to the equity markets to raise $15 million in cash at a really knockdown price. And a lot of people believe, given the fact that the stock is off so much from the highs, that this is a good buy. It's a good buy if you are willing to take political risk in a jurisdiction that's still figuring itself out politically. I didn't participate in the offering for just that reason. I don't have the ability to assess, with the information available to me, the level of real political risk in Niger. And I think the political situation in Niger is so much in flux that there probably isn't an analyst on the planet, including one resident in Niger, who can understand the nature of that political risk.
Okay, from Daniel, wants to know, how will Africa Energy Corp be affected after CNR International announced it will withdraw, and with Total Energies considering withdrawing from their joint venture offshore gas discovery?
Yeah, I have an idea that is going to open up more room for Africa Energy. I suspect that you will see the likes of CNPC and Mitsubishi come in there. A lot of that will depend on negotiations between the operators and the host government. So I'm still cautiously optimistic, but understand I'm more than cautiously optimistic about the seaborne natural gas trade as a whole.
Okay, let's see. Patrick, I'm sorry. Let's go to our friend Anonymous. Rick's thoughts on the absolute smash in PM prices last week.
I don't have any. I don't have any. I can tell you in my experience that you don't have block limit up every day. Some days you have down. Some of the selling that we see in the precious metals markets is always abusive. We've talked before in the Rule Classroom about the fact that while I don't believe long-term manipulation occurs in markets, short-term manipulation occurs all the time. And in precious metals markets, my suspicion is that the form it takes is as follows. Players get way short laddered in the futures market. Short 90 days, short 180 days, short 360 days, short 700 days. And then they borrow enough physical metal and sell that metal very aggressively overnight during a point in time when the physical market is its least active, so that they can have as much price impact as possible with the metal that they sell, hoping that that rapid downdraft in the physical market will have an exaggerated impact on the spot market. So as an example, if somebody was short, let's say $1 billion in the futures market on the short side and borrowed $50 million worth of gold that they dumped overnight, your hope is that by dumping that gold, you would reduce the price of the physicals markets enough that you could make a handy profit after paying back the portion of the $50 million borrow that wasn't covered with the sale. It's important to note that these leverage short and leverage long positions, these manipulations take place in the way that's the easiest to manipulate. And if we begin to see a really substantial and dramatic uptick in gold and silver quotes, what you will see is these same traders manipulating the market up as opposed to down. But you will continue to see volatility in the markets if, and this is highly speculative from my point of view, if you see even one, but more likely two, U.S. dollar, U.S. Fed rate cuts, I think you'll put a temporary end, at least, to the short side foolishness.
Okay, from Mark, what is Rick's current opinion and rank on Centaurus?
I have a 4 on Centaurus, which may be a mistake given the softness in nickel markets. I have a huge fondness for tier 1 deposits. And I like tier 1 deposits in out-of-favor commodities. It's important to note that the current nickel price isn't going to affect Centaurus because they aren't going to be in production for 2 or 3 or 4 years. But it does impact sentiment. That notwithstanding, Centaurus as I understand it, is a true Tier 1 deposit, well in excess of $10 billion in situ recoverable reserves and resources. A deposit that, it seems to me, as we model it in a rudimentary basis, would generate a plus 25% IRR at today's nickel prices, which is important, and would have all-in sustaining costs in the nickel market in general in the best quartile, and among sulfide nickel deposits in the best decile worldwide. So names like Centaurus, names like Meteoric, names like Sovereign, Tier 1 deposits in out-of-favor locations, in out-of-favor materials, are very, very attractive to me. I have all four of those as fours.
Patrick,
All three of those, pardon me, as fours.
okay. Patrick asks, would appreciate comments on Source Rock royalties.
Don't know enough about Source Rock to comment.
Han asks, what ranking will you give Largo? Is vanadium like uranium in 2021?
I have backed off Largo from a 4 to a 5. The reason I have done that is that their nascent product, the Largo Physical Vanadium Trust, has, as far as I understand, not been able to reach any supply agreements with original equipment manufacturers to manufacture vanadium redox batteries and, in fact, store their inventory in the batteries for a fee. That approach to the commodity business was really attractive to me and is still attractive to me in concept, but I haven't seen it occur in practice. I would point out that even at current vanadium prices, Largo generates free cash flow from their own vanadium operations in Brazil, so they certainly meet the standard of low all-in sustaining costs.
David has an interesting question. It's about whether or not your opinions have changed since the conference, Rick. Are you buying anything that you weren't when we last saw you in Boca Raton, or vice versa? What's changed?
I'm not. I'm taking a renewed or heightened interest in trying to figure out who the strategic targets for M&A are. I think that we're going to see, likely in the latter half of this year, a real rash of mergers. I had the good fortune yesterday to buy Ross Beatty a glass of wine for his birthday and talk to Ross about things that he saw in the precious metals markets. And Ross said the really overriding theme that he is seeing amongst his peers is the need to amalgamate, the need to cause bigger companies to occur that have greater trading liquidity, that can be included with a larger weighting in more indexes, so that you get the passive buyers. And combining that passive buying, the index-oriented buying, with at-the-market financings in the U.S. NASDAQ or the New York Stock Exchange would seem to be the way of the future in the gold mining business. That discussion has caused me to really be on the lookout for single asset producers or even smaller multi-asset producers that could be gobbled up by bigger rivals, creating larger holes that enjoy more trading liquidity and better access to capital.
Curious, did he say that before the wine or after the wine?
We didn't have enough wine for it to impact either of our outlooks. When I say
Okay.
a birthday glass of wine, I mean precisely that. So it was
No truth serum effect?
no truth serum.
All right. Let's see. Peter asks about, Global Atomic we've talked about, but Discovery Silver. What are your thoughts on that?
Don't know enough about Discovery to comment.
Okay. Ricardo wants your thoughts on Trilogy Metals and whether it would take a new administration for him to be interested again.
Yes. I think in the absence of a Trump victory, a continued Kamala Harris-Biden administration, I think precludes any federal permission to build an access road to that deposit. if we do see a Harris administration, and if Trilogy sells off a lot, I may very well buy some with the point of view of holding it for 4 years. That's an extraordinary deposit, and it's a deposit that enjoys local support, albeit there aren't very many locals up there. It's really truly in the middle of nowhere. Those few people who live there, primarily native people, are broadly in support of the project, but there aren't very many of them. And some aspects of the environmental community, people like the Tides Foundation from the Hewlett family, who are very, very active Democratic fundraisers, are vehemently opposed to that access road. So I think a Democratic administration puts that deposit, figuratively at least, on ice for 4 years.
Okay. Chris asks about a new rebar steel standard in China and how it will affect vanadium and therefore Largo.
Should the rebar standard be adopted with a much larger vanadium component, I think what you'll see is a global tightening in the vanadium market, understanding that vanadium fabrication and vanadium finishing is largely a Chinese business. It could have a real impact on the vanadium market. And of course, anything that had a positive impact on vanadium would have a positive impact in Largo. Remembering that my interest in Largo 2 years ago was less involved in its metallurgical properties and more involved in the application of vanadium in utility scale batteries. And that, with regards to Largo, has not yet taken place.
Okay. I want to grab a question from X, formerly Twitter. Jorgen asks, any thoughts on the iron business, Rick? Companies like Mineral Resources and others with new mines in Australia.
Very good business. I have learned in those very, very, very large markets, iron, met coal, stuff like that, you really, really, really want to concentrate your money on the lowest cost producers. So you want to be in the Pilbara, as an example. Those names are names, with the exception of Fortescue, aren't merely pure iron players. BHP and Rio are large iron players, and they're huge Pilbara iron players, but they aren't pure plays on iron. You can do well on the smaller iron producers, but my own belief is that the strength in iron that we've seen, the relative strength that we've seen in iron over the last sort of 10 years, might be a little long of tooth. And while iron prices won't necessarily trend off, I don't think that they're going to trend up as well either. I note, too, with specific regards to Australia, that the iron producers, large and small, are generating so much cash that various levels of government, the national government and the WA government, are becoming increasingly attracted to finding ways to steal some of that cash. So that would be a comment that I would have for you. I am a long-time player in the iron business, but I can tell you my iron stocks include Labrador Iron Royalty, because I like the pass-through structure. I like the fact that free cash flow accrues to me. A nice place for it from my viewpoint. A related company, Altius Minerals, which has an iron royalty and also is a large holder of Labrador Iron. And then in the real iron space, I own BHP and Rio both. I used to own Vale, which was the other global low-cost producer, but until there's a resolution of their tailings dam failure in Brazil, a resolution either through the courts or through private negotiation, I'm not a Vale buyer anymore.
Okay. Sean wants to know your thoughts on the following companies, Rick, any or all. Pan American Silver, Mag Silver, Equinox Gold, Franco-Nevada, and Cameco.
I'll try and remember what was said. MAG seems to go from strength to strength. It's not cheap. There is, I believe, to the west, very strong exploration upside, something that I hope that the company will turn its attention to now that they are in production.
Okay. Pan American?
Pan American Silver, I have always liked because of the upside associated with the undeveloped asset in Argentina and the shutdown asset in Guatemala. I did my best to press Ross Beatty about both of those assets. And he looked at me and smiled and said, I'm through forecasting. I don't know.
That's where the wine would come in handy, Rick. You gotta.
Yeah, he's a very optimistic human being, but he finally, he's been working on Argentina now for 13 years. So I couldn't even get him to say in his lifetime. Operationally, things are going fairly well at Pan American. They are continuing to integrate the assets that they acquired from Yamana. They are selling off their two-tier assets. All that's good. In Equinox, everything, I think, really hinges on, now that they have completed the construction on the Abitibi in Canada, attaining nameplate capacity on that. When, and I think it is a when, they get to nameplate capacity, probably 5 or 6 months from now, I think that the free cash from that deposit will course through Equinox. Now, the Equinox share price has done well of late. And having concentrated on the Hard Rock deposit, the Abitibi deposit, they need to refocus on some of their smaller operations, which have been ignored while they were focusing in Ontario. It seems to me that they're having operating problems at Castle Mountain, and unless they can make that thing bigger, I don't know that those cost problems are addressable. And I think they need to be more clear with the market in terms of the progress in their community relations efforts at Los Filos. If they can arrive at a new agreement with those communities, the existing open pit operations that they have, which don't need to be permitted in Mexico, could be expanded. And that could become a really, really, really serious money spinner for them. But we need resolution of those two things. Cameco, I just think be right, sit tight. They have a lot of stuff that they carry on their books as resource, which would be focus ore for other people. It's such a treasure trove in the uranium space. The risk with Cameco, I think, and this does keep me awake at night, is that, of course, they bought that Westinghouse business, or half of the Westinghouse business. So in addition to being uranium miners now, they're going to be nuclear power plant builders, nuclear power plant owners, operators, enrichment facility operators. In other words, they're going from being in one business to being in 5 businesses. I understand their want to be a cradle-to-grave energy supplier from uranium. I'm just afraid of the execution, trying to run 5 businesses instead of 1. That's what bothers me about Cameco. Okay. And I don't know if there was another name.
The last one was Franco, Rick.
Franco,
getting
relax.
closer to a resolution on that, or what's going on?
I have no idea if they're getting closer to a resolution, but it doesn't matter. The stock sold off by 40% because the Panamanian government took away an asset that was 14% of net asset value. This is the highest quality gold company on the planet. There isn't an excuse for a gold portfolio that doesn't have it.
Okay. Want to go to Marco, who comes in via Rule Investment Media. Wants to know your thoughts on Chicana Copper. I
was very disappointed with the drill hole. It doesn't mean the game is over there. I owned the company because I thought those breccias contained enough copper, and I still think that they could be sold for the market cap of the company, meaning that my downside was effectively zero. But I wasn't owning it because I thought it could be sold for my investment. I was owning it because I believed that those tourmalinized copper breccias were indicative of greater copper mineralization at depth. I was attracted to the fact that there were really two targets. There was a big golden soil anomaly, and then there was a geophysical anomaly that was interpreted by several people, myself included, as being a very, very viable copper gold porphyry. While the drilling that was done wasn't sufficient to condemn either thesis, it certainly didn't prove either thesis either. So rather than moving on to the second unanswered question, we're still trying to solve the first unanswered question. Meanwhile, the company is effectively out of money. So I need to see how they propose to finance the company and what they propose to do with that money. If they're coming to me for some of it, I'm happy to listen, but they need to show me. It's very seldom that somebody drills their worst idea first. So they need to show me the information they got from these failed drill holes and show me how the information that they got from those failed drill holes and their reinterpretation of either the golden soil anomaly or the deep porphyry target becomes a viable exploration punt again. Otherwise, for me, it's a failed exploration speculation, one of dozens I've had in my career.
Yeah, this seems like a good opportunity to learn here because this is hardly rare, right? I mean, this type of situation you find yourself in as an investor.
When we talked about this in the rural classroom, I said the expectation in blind exploration is failure.
Right.
What I liked about it was that I thought my ultimate downside, if they liquidate the company, if they have to liquidate the company, is break even. Now, there is a different downside, which is to say that they use that baseline value of $10 or $12 million to raise another $2.5 million in exploration. Blow that up. Do it again. Blow it up again. So that they dilute my interest in that $10 million baseline valuation so much that my interest isn't pari passu any longer. Those are real risks. The other reason I liked it was, of course, the size of the prize if they hit. Occasionally, the old speculator in Rick Rule comes out. You find a $6 million market cap that you think could be $120 or $150 million market cap if the geophysical anomaly that they think they see, they hit, and if it contains economic mineralization. If you are taking a bet where a $6 million company could become a $150 million company, you need to understand that the probabilities are that you're going to fail.
Mark asks your thoughts and rankings for Rio 2 and Montage Gold.
Montage has had a hell of a run. So if you're buying Montage now, you are buying it because, well, first of all, the Montage deposit has proved up better than anybody, myself included, thought it would when I helped finance them. You're buying them because the Lundins have taken effective control of Montage. It will be their West African consolidation vehicle. And you're buying it because a good part of the mine build team that was so successful at Endeavor Mining left Endeavor and went over to Montage. In other words, you're buying it for the future, not for the present. The present, I think, has been built into the stock, which has been extremely pleasant. A 12 or 14 month triple in a market that goes sideways is not a bad outcome. So we've already enjoyed ourselves a lot in Montage. And I'm sorry, what was the second name, Albert?
It was Rio.
Rio 2. Now, Rio 2 is a different circumstance. This is a legitimate development target, and it's a legitimate development target that the market is uncertain about because it looks to be going into the boring part of the Lassonde curve, which is to say perhaps a really good investment and a really lousy trade simultaneously. If you are the type of investor who tries to employ short-term tactics on long-term strategies, avoid Rio too.
Okay.
If you are the type of speculator who looks at risked net present values that are 8 to 10 times the size of the market cap, but are willing to endure the market vicissitudes for the 3 or 4 or 5 years it takes to play that out, then it's a very different circumstance. Note, I'm pretty long Rio 2, and I'm also personally friendly and have been personally friendly for 3 decades with the CEO.
From David again, Rick, we had a chance to visit with Fission at the conference. Can you tell us what you heard and then what are your current thoughts on Fission?
I was surprised by their agreeing to be acquired by Paladin. I am in favor of all amalgamation. I would rather have seen an amalgamation that included NextGen because I think those deposits need to get built together. I can understand from the Fission management's viewpoint, a merger that included them as part of the ongoing management team is preferable to one that didn't. And I think at least some portion of the Paladin acquisition had to do with the fact that Paladin didn't have any North American management and would need it to build that deposit. I still believe that NextGen and Fission's deposits need to be built together. And perhaps Paladin sees the same thing and sees themselves now as a strategic player in that development. What's interesting about the merger on a standalone basis is that Paladin has just successfully returned a mine to production. It won't be at nameplate capacity for 6 or 9 months. But if you look, first of all, at their now proven ability to at least restart, if not build a mine, and if you look at the fact that the production from that mine could be used for the initial service of long-term contracts in amounts necessary to finance Fission's aero deposit in production, you can see the rationale behind the trade. Of course, the fact that the trade was done at a 28% premium to the 30-day trailing VWAP is attractive to recent holders, although many people have complained about the fact that the transaction was done at a discount to the price that existed for Fission a year ago. At any rate, I am accepting the deal. I am accepting Paladin script, which I already have a lot of, and I'm accepting it in hopes that at some point in time, NextGen and now Paladin come to their senses and agree to build that together. It's also important to note at Fission that the dominant shareholder there was China General Nuclear. And the probability that the Canadian government would have allowed China General Nuclear to be the majority shareholder putting that deposit into production is nil. There were strategic implications there that the Fission management team needed to do something about. And I think probably with the concurrence of China General Nuclear, I think they'd probably rather have at least an offtake arrangement with Paladin so that they had access to supplies from Australia, from Namibia, and from Canada. So I can understand the strategic rationale from the Chinese perspective.
Okay, very interesting. Thanks for that. William wants to know your opinion of Nickel Industries.
If Nickel Industries is a company, I don't know anything about them, so I have
This is
no opinion.
an Indonesia producer.
I don't know them.
Okay.
The lateritic nickels in Indonesia are the lowest cost in the world, but I don't know Nickel Industries.
Okay. I noticed Seabridge had a little bump today, Rick, and Seth wants to know wants your updated opinion on Seabridge and the possibility of a JV getting done in the next 12 months.
I am leery about a JV getting done in the next 12 months, assuming that the gold price doesn't move for the next 12 months. This is extremely gold price sensitive. This is one of the largest undeveloped gold deposits in the world. But the upfront capital cost to build it will be at least $7 billion, perhaps $9 billion. And I think that you need to see a very, very, very strong gold price to tempt somebody out of the woodwork. The obvious partner would have been Barrick, but with Barrick now committing to spend $8 billion to build the Reko Diq copper gold deposit in Pakistan, I think there's only so much that Bristow wants to chew at one time. So if somebody is holding Seabridge because they're looking for a transaction in 12 months, I think they're making a mistake. I think you own Seabridge because you think that there is a possibility that the gold price goes through $4,000 sometime in the next 2 or 3 years. And I don't think that's out of the realm of possibility at all. If that occurs, then you'll see the gold mining industry absolutely unwilling to resist access to a 100 million ounce deposit.
Okay, so we're getting ready to wrap up here, Rick. I want to alert people to the boot camp that we are hosting next month. And this is an exciting one for me, Rick, because it focuses on one of your specific areas of expertise, and that is private placements. So can you just give people a little bit of an idea of what you're going to be covering? These boot camps are pretty extensive. We bring in keynote speakers from all over the industry, but this particular one is going to feature the one and only Rick Rule, which is nice.
Private placements, well, it's a topic that fascinates me because I've done very well with it. It's also a topic that I'm well placed to teach because I've been very actively involved in private placements and creatively involved in private placements for 50 years. I believe I have a durable competitive advantage in private placements. We're going to talk about parts of the private placement business that other people don't talk about. In particular, debt placements and convertible preferred placements, which I think will be very, very important components of the market, and also private credit over the next 5 years. What will be different about this one is that there won't be any immediately actionable investment information. At every other boot camp we've done, Albert, we've tried to have 3 or 4 issuers so that people could use the lessons we were teaching in the boot camp in real time and assess whether or not there was any value to be had on a current basis with regards to our exhibitors. And we've made our attendees a lot of money doing that. There was immediate benefit in addition to intellectual gain. My hope is, with regards to the boot camp, in addition to my own participation, I will be our own keynote speaker. There are 3 or 4 other people who are well versed in various aspects of the private placement market who we will have on as guests. What we likely will not have are sponsors where attendees can practice the lessons taught in the boot camp in real time. I would urge people who are either accredited investors, meaning portfolios valued in excess of $1 million, or aspiring accredited investors to pay attention to the boot camp. For those of you who aren't, the information that you see there will be more educational because you won't be able to employ it. Usually there are requirements in terms of participating in private placements that you have $1 million net worth. There is an exclusion for Canadians, so Canadian viewers who want to use the close friend and business associate exemption or the knowledgeable investor exemption can get benefit out of it. But for U.S. persons in particular, immediate utilization of the boot camp is probably limited to those with portfolios worth in excess of $1 million, or people with 2 years of annual income in excess of $250,000, and the reasonable expectation that that continues.
Your knowledge of the law is impressive, Rick. In addition to everything else, you have to cram in your head. The knowledge of these regulations is impressive. So this is going to be one for the intellectual bank account, as Rick said, but well worthwhile. Because this is an area that, all these topics, but this one I feel is like the information is not very easily accessible elsewhere.
I don't think this information is accessible easily or not easily anywhere else.
Right.
It's taken me now, Albert, 50 years to get this knowledge.
Yeah.
Some of the techniques that will be described, I literally invented as a consequence of running into problems that were unsolvable with the then existing structures. If I had to think about an area where I truly have a durable competitive advantage over most other people in the market, this is it.
Okay, so go to rulesymposium.com/bootcamp. If you're in the classroom, there's a link on the main page that'll get you a discount. I don't have the date in front of me, Rick. I think it's August 24th, Saturday.
Knowing you, it's posted all over the place. So.
Yeah, it's too much going on right now. I don't have it in my memory.
One other thing that we need to emphasize is the fact that we put on a hell of a conference in Boca Raton, and those conference tapes are still available, and they're still valuable.
I gotta get yeah. Okay. So let me. I haven't been helping with the promotion of that, but I will. I'll get. I'll chase it down and find out how people can get the recordings. The speakers this year were great, Rick. I made a joke on stage that wasn't really a joke, but it was funny, and that is I'm finally starting to get some of this stuff. After participating for so many years, I'm actually developing an affinity for these geologists. So that was good.
I think the other thing that happened, the speakers were of uniformly high quality. The other thing was that bringing on Paul Harris from the Mining Journal to act as the sort of roving reporter for the tapes and put what was being said in context really, really, really increased the value of the recordings. I wish we'd done that over the last couple of years. But being better able to integrate the recorded part of the conference with the live part of the conference really adds value to everybody, whether you were there or not. If you were there, we gave you 60 hours of programming in 4 days. There's no way on earth that you could absorb it all. In order to get your money's worth out of the conference, you're going to have to play the tapes anyway. For those people who couldn't be there, this is an extremely high quality product, and it comes, like everything else from the Rule Classroom and Rule Media, with an absolutely gold-plated money-back guarantee. If you buy the tapes and you don't think it was worth what we charged you, email us. We'll give you the money back. Financial risk is all ours. We can't give you your time back, and you're going to spend a lot of time on these tapes. But they are really, really, really well worth it if you're going to be in this sector.
Yeah, and if you buy them and you're disappointed that they're not actually tapes anymore because it's 2024, we'll get your money back as well. It was outstanding. And one of the things that these 60 hours of presentations, they include parallel sessions. So there's no way, even if you were there, you could have seen them all because while you were attending one presentation, there was another great one going on next door, 3 or 4 other great ones going on next door. So please take advantage of that. Rick, once again, we are over time, so thank you very much. I want to thank you for doing these. I know everyone appreciates it, and can't wait till next time.
Great. Thank you, sir. Thanks for causing it to occur.